Do you have a relatively small amount of money that you're trying to grow through investing? I'm talking anywhere from a few $100s all the way up to a few $1,000,000. Well, at the Berkshire Hathaway annual meeting in 2001, Warren Buffett was asked which method he would use if he were managing a small sum today. Let's talk about what we can take away from his answer to that question. Hey everyone, welcome back to the channel. My name is CJ and I'm a software engineer and investor based in Chicago. And today I want to talk about what I've learned from Warren Buffett about growing small amounts of capital at high rates of return. I'll go over a brief history of Warren Buffett's outstanding returns, then I will talk more in depth about the answer to his question, and then at the very end I'll give a few practical tips for how we can hope to match Buffett's outstanding returns. Before we begin, please like the video and subscribe to the channel if you want to keep up to date with more content like this in the future. Oh, and by the way, this is not financial advice. This is just a discussion of what I personally have learned from Warren Buffett. It's for educational purposes only. Okay, let's dive into it. In Buffett's early career of managing other people's money, from about 1956 to 1969, Buffett's compounded annual rate of return was around 29% versus the paltry 7% for the Dow Jones. That means that Buffett was doubling his money every 2.5 years, compared to if he had just invested in the Dow Jones, he would have doubled his money in 10 years. Those are some pretty outstanding results and definitely some of the best ever. Even though he had such amazing compounded annual return rates over that period, he trounced his own rate from the decade starting in about 1950, where he compounded annually at 50% a year. With that rate of return, he doubled his money every year and a half. That's just incredible. So how did he achieve these amazing returns? Well, let's first go over the answer that he gave to the question of how he would invest a small sum of money. Buffett's answer was that he would still be using the same method of valuation that he uses to this day, which is to find businesses that are selling at the lowest price compared to the discounted cash flows that the business would be producing in the future. This sounds a lot like the method that Buffett uses to this very day, where he will buy a wonderful company at a good price and just let it compound over time. Examples of some of his more successful investments of this style would be Coca-Cola and most recently Apple. But his answer also applies to another style of investing. He was interviewed again, I think this was in 2013, where he was asked the same question about how he would manage a small sum of money. And in this video, he was more explicit. He said that he would be more inclined to look at the classic Graham style stocks, which means that they are trading at favorable quantitative metrics. Some examples of these quantitative metrics would be a low price to earnings ratio, low price to book ratio, or selling for less than working capital. During the period in the 1950s where Buffett was returning 50% per annum, he had just met Benjamin Graham and went all in on his investment philosophy. He was focusing on these quantitative metrics when valuing businesses. Basically, he was searching for 50-cent dollars, waiting for the price to return back to its fair market value, and then selling them quickly. Even if the company is a low quality one, we can expect it to produce future cash flows for owners at least equivalent to the cash on the balance sheet, excluding debt and other obligations, of course. He gave the example of how he literally leafed through a manual of South Korean companies, and he invested in a basket of quantitatively cheap companies. He couldn't even pronounce the names of these companies, but they were so cheap on a quantitative basis that you just had to make money on them. Quite a few things have changed with Buffett's approach over the years, but a huge difference is that the total universe of stocks that he was able to look at when he was running a relatively small amount of money is vastly larger than the universe of stocks that he can currently look at while managing Berkshire Hathaway's portfolio. For smaller investors, we have thousands upon thousands of investment opportunities. But for Buffett, there's maybe only a handful of public companies out there that he could buy that would actually make a sizable impact on his portfolio returns. Berkshire Hathaway's current portfolio is worth over $200 billion. And 50% of that is Apple. So it's going to take a big investment in other public companies like Amazon or Facebook or Google to make a sizable impact on his portfolio. From a sheer percentage perspective, smaller investors have a much greater opportunity to compound at really high rates compared to someone like Buffett. So if a fund running about $5 billion makes a 10% investment in a company that's only valued at $200 million, that's a $20 million investment. That would make the investment less than 0.5% of the entire portfolio. So even if it did really well, it would barely move the needle at all. Obviously, if that $20 million were to double to a $40 million investment, in absolute terms, a $20 million gain is excellent. but in relative terms, smaller investors can do a lot better. Okay, lastly, let's talk about some practical tips that we can use to try to come close to Buffett's compounded annual 50% returns. But first up, I want to preface this with some cautionary remarks. Let's face it, you and I, we aren't Warren Buffett. And information today is a lot more easily available than it was back in his heyday. Flipping through the Moody's manual in the 50s and 60s yielded obviously undervalued companies, like miners unearthing nuggets of gold in the peak of the gold rush. Everyone can run a simple screen and find these Graham-style undervalued quantitative stocks. According to both Warren Buffett and Charlie Munger, it is not going to be so simple or obvious as when they started investing. I'm not trying to diminish Buffett's accomplishments at all, but he will be the first to admit that it has gotten a lot more complicated. And of course, this is not a get-rich-quick scheme. It will take a lot of work and focus to achieve high returns. But with all that said, it is theoretically still possible to achieve outsized returns with a small amount of money, simply because there's less competition in these smaller spaces and a lot more volatility. I know it probably sounds old-fashioned, but step one would probably be to leaf through all of these stock manuals, starting from A, going through Z. Of course, you can do this digitally. Since you have a small amount of money, literally any public company could be a big investment opportunity for you. You could invest in a company only valued at $50 million, or you could invest in the largest company, which is Apple. But that begs the question, why would you want to go hunting where all the big boys like Buffett are looking? Some of those prices are high enough to be in the nosebleeds. We should hunt only where the small investors can go. So as a general rule of thumb, the smaller the company, the bigger the opportunity for the small investor, but the more volatility there is. The microcap and small cap spaces are the bread and butter for small investors. These are companies typically valued maybe from $300 million or less. If there's one place that big hedge funds can't go searching, it's in the small and microcap spaces. You may want to do some more research about Ian Castle, who is one of the more renowned microcap investors. I would personally follow Buffett's advice and follow a hybrid approach. Search for a basket of traditional Graham-type value stocks, all while investing in great companies if you stumble upon them. Become well-versed enough to be able to value both types of companies, especially starting out. You may find that you perform better in one area when you first start out. For instance, I found that quantitative stocks were a lot easier to value at first than these long-term compounders. Over time, you can increase your fluency in identifying and valuing these great companies with long runways, and by that time, hopefully you'll have a larger sum of money to put to work. It's also possible to use Mohnish Pabrai's old technique of finding companies with a hidden PE of 1. What this means is that with a little digging and research, a company that is selling for a higher PE ratio might actually be selling for a PE of 1 based on their future cash flows and earnings. For example, he found his investments in Fiat Chrysler and Rain Industries using this philosophy. It's kind of a modern twist on the old Graham style type of investing. I've never tried this approach personally, but it might be worth thinking about investing in public companies like a venture capitalist. I don't know if this idea has any merit, but you could potentially buy a basket of high-growth, unprofitable companies and hope that maybe one or two of these winners will completely trounce the losses of the rest of the basket. However, obviously, there's no guarantee that this or any other method would work because there's no guarantee that you will actually find a winner in this basket. This would probably be more in line with looking for long-term compounders, so it might take a little bit more effort and time than looking for typical Graham cigar butt investments. As for geography, when I first started out, I focused only on my local market, so I didn't look at any opportunities outside of the United States or Canada. But as I got more comfortable and experienced with investing, I started to look outside of North American markets. Now I have countries like South Korea, Japan, China, India, and Turkey all on my radar. There are plenty of super investors who have investments in these countries. I talked about earlier how Buffett bought a basket of South Korean stocks, and Mohnish Pabrai has investments in Turkey, Japan, South Korea, and India. Anyway, I want to reiterate that this is not a get-rich-quick scheme, and while it's a good idea to aim high so you aren't limiting yourself with your beliefs before you even get started, keep in mind that Warren Buffett is one of the greatest investing intellects of all time. And of course you can achieve excellent returns with other methods, but this is what Buffett has taught me. So be open-minded when you're learning, and remember that it's okay to make mistakes. Even Warren Buffett makes investing mistakes. If you want to learn more about Buffett's early years in investing, please check out the book, The Making of an American Capitalist. It's by far my favorite biography about Buffett, and it's worth its weight in gold in investing wisdom. Please like the video and subscribe to the channel if you enjoyed the content. Let me know in the comments below if you have any other great ideas for investing small sums of money. You may want to check out my curated investing playlist over here, where I explore more investing topics in depth. Thank you for watching this all the way to the very end. I really appreciate it, and I will see you next time.